Sure, if you have any investments out there, and I know I've got some wealth managers at my table here, but anyone who's followed the financial markets over the last several months have seen a lot of volatility. Now, if you think back in November, December, things were pretty stressful in financial markets. We saw the stock market decline quite substantially. A lot of questions, a lot of concerns started to emerge. But over the last 3 months or so, everything has gotten the entire market has more or less reversed those declines, which speaks to a lot of the uncertainty. Again, where we are in the economic cycle, we're at the top. There's more and more people thinking, or investors thinking, that it can't go on forever. We're that close to a recession. And I'll spare you all the details, but the point of this one here, but the point is there's a lot more, that concern leads to a little bit less risk taking on the parts of the financial market compared to about 6 months ago or a year ago, where things looked like really positive, not just in Canada but globally. Things were starting. You saw the U.S. economy running more or less at full tilt. Things were starting to turn around in most of Europe, not all of Europe. Now the global economy looking pretty good shape, notwithstanding some of the trade talks and trade wars that were out there. And so, but since then, because of the volatility, the global investors have become more guarded, and a lot of attention now is turned towards kind of signs of, like, what I like to call looking for cockroaches out there. Now, where the moment you see one, there's more than one usually. And one of the indicators a lot of people are putting a lot of attention on, and you might have heard about, is the yield curve, so which is the difference between long-term interest rates and short-term interest rates. And usually long-term interest rates are higher than short-term interest rate, but there are times in episodes in time when that curve inverts, so the longer-term interest rates get lower than short-term interest rates. And why some people pay a lot of attention to it is that it's been a remarkably accurate predictor of recessions in the past. Usually when the curve inverts, it was able to predict the last 3 recessions pretty accurately within a space of about 12 months. And what we've seen more recently is that, as recently as a couple weeks ago, I believe, that we had an inverted yield curve in the US and in Canada, which led more and more in the financial markets and out there start to talk more and more about a recession coming up. It brings a lot of uncertainty. You in business, you start to think, well, people are less confident. They're not making those big decisions, for example, in terms of investing, building new plants, hiring more people. This is just not like a very comfortable environment. And our view is that, yes, the yield curve may be inverted. It may have been an accurate predictor of recessions in the past. This time around, we don't think it's necessarily predicting a recession coming up. There's a number of reasons why these days longer-term interest rates are lower, inflation being not there, for example. The fact that short-term interest rates is more policy-driven, also central banks control this one, is still not high by historical standard. If anything, interest rates are still low. And the fact that there's still a lot of stimulus that are weighing on long-term interest rates. Anyways, all of these factors, in our view, point to, yes, a slowdown in the economy, which is already underway. We've already seeing this. The numbers show it. But not necessarily going into a contraction mode. But that's true here in Canada. It's also true in the US, for example.